Hey everyone, I hope you had a wonderful holiday season and a great beginning to the new year. I know from a market standpoint, we're all probably pretty excited to see 2022 in the rearview mirror. I know when you look at the different indexes for the market, whether you look at the Dow Jones, which was down about 8%, you look at the S&P 500, which was down 19.44%, or you look at the NASDAQ, those high-flying tech stocks, they were down about 33%. Definitely was a year that all boats didn't rise and fall at the same rate. So had a lot of variety across the different markets. Also, obviously, in 2022, the big word that everybody was looking at was inflation. Started off red hot at the beginning of the year. Once again, the Federal Reserve started their interest rate increases, and by the end of the year, inflation really had become lukewarm. We've started to see the auto market soften, especially the used car market. Prices have already started to come down. Gasoline prices, we've all been to the gas station and we've really started to see gas prices come down. For those of us in California, not as much as our clients that are on the East Coast. I know their prices have come down substantially. Had one of my clients recently tell me they bought diesel at $3.11, which I think people out here would love to be able to afford diesel at $3.11. But then also the housing market. We've seen a lot of basic standstill when it comes to housing, and it's such a big market and something that I'm asked a lot of questions about. We're going to actually have a specific video on the performance of the housing market and where we think it will go in 2023 out in 2 to 3 weeks. So be looking for that. Obviously, the inflation caused the Federal Reserve to raise interest rates. So we went from 1/4%, 7 interest rate increases later, we're sitting at 4.25% to 4.5%. They continue to think that they're going to raise rates for the next year by about 1%. I honestly don't think that they'll get any of those off, maybe 1/4 point in February, but that would probably be it. And then I think they have to pivot to a more neutral standpoint. And then eventually at the end of 2023, probably a softening or begin to lower interest rates. So you probably say to yourself, Henry, what are we looking at in 2023 then? And when we look at 2023, definitely I think it's going to be, are we in a recession? How bad is the slowdown? It's kind of really a technical term, whether it's recession or not. We're basically talking about the economy slowing down, and it definitely is. And so really the question is going to be is how much is it going to slow down? Just today in the Wall Street Journal, they looked at the largest banks in the United States. 23 of them thought that we would see a mild recession in 2023. 2 of them thought that there wouldn't be a recession in 23, but there would be in 24. And 5 of them said that there would not be a recession at all. If you look at a couple of other key indicators, banks have tightened lending standards. That happens all the time as we get into a recession. They're doing it again, basically not being as easy to borrow from them. Also, the demand for loans has also come down. Both key indicators that show that we are in a time of slowing demand. Also looking at the job numbers. Just before the Christmas, you started to see a lot of tech companies doing some pretty big layoffs. Just today, Salesforce announced that they were laying off 10% of their workforce. However, when you look at the unemployment number, it hasn't softened all that much. And I think one of the reasons why is this recession will probably look a lot more like 1999 than 2008. What you're going to see is a lot of those technology, high-paying jobs probably soften, but you're not necessarily going to see the service kind of Main Street jobs soften. There's been such a lack of employees. Some of the oversupply will dry up, but you won't necessarily see those jobs go away. The other thing that you look at is leading indicators. Manufacturing has now gone into a contraction. The ISM number came out today at under 50, showing contraction. Also, the stock market. Stock market is a leading indicator. It's basically showing that 9 months to a year down the road, Main Street is going to soften. So about a year ago, markets started to soften. Now all of a sudden, we're starting to see those numbers hit. So that most definitely are signs that 2023 will see a softer economy. Does that mean that we will see a softer market? Not necessarily. Typically, the market starts to repair itself just as Main Street's kind of getting into the bottom of the slowness. So I would anticipate some speed bumps in 2023 Q1, but by the time we hit Q2 and then on into the latter half of the year, we'll definitely start to see the market pick themselves up. I would imagine we'll probably see somewhere around an average return 8 to 10%. I know I've seen several analysts think that it'll be higher than that. I'm not too confident in that, but I do think it will be positive returns for next year. Part of the silver lining this year is also, since 2008, we have not been able to add bonds or fixed income or CDs to a portfolio to really balance out the portfolio without having a significant decrease in performance because interest rates were so low. The last quarter, we've been able to put in short-term treasuries, CDs, high-grade corporate bonds, and get anywhere from 4.2 to 5%. So we're really excited for the next 12 to 36 months that our portfolios can be a lot more stable and a lot more balanced and still get great performance because of the higher rates of return we're getting on fixed income items. Also, as we move into 2023, there's some real big changes that just came out and were kind of just announced late in the new year or late before New Year's Eve, and we're just getting the information on it right now regarding some changes to IRAs and 401ks. I'm also going to put together a separate video on those and kind of go over all the information. To be honest with you, we haven't even got to digest it all yet. It's quite lengthy, so we really want to bring together all the information and share it with you. So look forward to a housing video and an IRA 401k video coming out in the next couple of months, and that should hopefully bring some new information. Also, we're starting our yearly reviews with all of our clients, and so you'll be getting a phone call from us getting those set up. I hope everybody has a wonderful start to the new year, and if you have any questions, never hesitate to call. Thank you.